South China Morning Post, 17th of October 2022, Why Asian Hotels Are Doing Fine Even Without Chinese Tourists. Chinese tourists have been known to go only to hotels and restaurants run by Chinese people, which lessens the effects of tourism. Now, tourists from other countries visit the best motels and restaurants that meet their needs. People from India were thought to be some of the best tourists. It would be too mild to say that the hotel business has had a rough time over the last 2.5 years. Lockdowns and travel limits were implemented because of the COVID-19 pandemic, which threw the sector for a loop. Hotel occupancy rates dropped to between 20% and 40% in the Asia-Pacific region, which depends significantly on foreign tourism and has a thriving market for meetings, incentives, conferences, and exhibitions. The number of hotel deals in the region dropped to just over $6 billion in 2020, which is less than half of what it was in 2019. But now that economies are back up and running, pent-up demand for business and pleasure travel drives up occupancy and daily rates. This means that the recovery is taking hold. According to hotel data provider STR, the average occupancy rate in the region's main towns was 61.3% in August. This was down from 73.7% the following August. Occupancy rates are currently higher than 70% in Singapore and Mumbai. Also, there is more investment activity in the sector now than a year ago. This is because private investors across the region have record amounts of money ready to be used. Data from JLL shows that there were $8.4 billion worth of transactions in the first 9 months of this year. Of those, 72% were in Japan, Australia, South Korea, and China. Japan, the last major advanced economy with strict border controls, started letting vaccinated tourists last Tuesday. This was a big step forward in Asia's recovery from the pandemic. Japan depends mostly on domestic tourism, but Nihat Erkan, head of investment sales for Asia Pacific at JLL, said that the reopening was a vital sign that Asia's second-largest economy and the most active hotel investment market in the area were back to normal. Erkan said, "Asia is waking up from its COVID sleep." But even though people in the area are getting used to the virus, the most significant business keeps its borders closed. The recovery is significantly slowed down by China's dynamic zero-COVID strategy, which will last longer than most people thought it would. Data from CBRE shows that Chinese tourists made up only 4% of all foreign arrivals in the region's most popular destinations in the first 7 months of this year, down from 25% in 2019. This shows how much the strict rules are slowing down growth. Beijing's zero-tolerance policy toward the virus has done a lot of damage to markets that depend on Chinese tourists. According to STR, Vietnam had the worst performance in Asia last month. More than 25% fewer rooms were booked than before the pandemic, even though Chinese tourists made up almost a third of all foreign visitors that year. Other signs, though, show that Asia's hotel business is doing pretty well overall, even though it is missing its single most important feeder market. STR data shows that in August, hotel daily rates in Asia's top areas were only 8% lower than they were in August 2019. The pace of the recovery without China being there has surprised everyone, said Steve Carroll, head of hotels and leisure for Asia Pacific at CBRE. In a study released last month, CBRE noted that hotel lease periods, measured in days instead of months or years, made it easier for operators to change prices much more quickly. This made hotel properties a better way to protect against the rise in inflation. Also, China's zero-COVID policy is just one of many problems the Asian hotel business has to deal with. Another reason is that China doesn't want to use foreign vaccines, even though their medicines don't work. But the most important one is the severe lack of staff that keeps planes from adding more seats to meet the high demand. Seats were 20 to 30% less in total in Northeast and Southeast Asia in the first week of October than in October 2019. Airlines have it worse than hotels when they say they don't have enough staff, said Jesper Palmqvist, Senior Director for Asia Pacific at STR. Costs for individuals and businesses are going up quickly, also pulling down the recovery. As a result of rising airline fares, travel spending is going up sharply across the board. At the same time, hotel owners are seeing huge rises in their running costs, especially labor costs. The sharp rise in interest rates, the substantial rise in the value of the US dollar, and the greater chance of a global recession are all putting more stress on the hotel industry in Asia. But Japan is an excellent place for foreign investors to put their money because interest rates on loans are still zero, and the yen has been at its lowest level against the dollar in 30 years. Even investment activity in China will likely slow down because weak developers are selling off their assets. JLL thinks that Beijing's efforts to reduce debt will lead to $2 billion worth of deals next year, making China the second busiest market for hotel investments after Japan. The hotel business in Asia would still improve even if Chinese tourists didn't return. As a part of a recovery, the area is doing amazingly well.